Hey everyone, welcome to the Your Money Your Life podcast. We're on episode 302 of the pod. So make sure wherever you're listening, you like, subscribe, 5-star rate, and review this podcast. Let's get into it. We have a decent amount to cover. There's a lot of actually new news that has popped up. So let's go through it first. But first, let's actually get into the market update. The market is actually trading when I'm recording this. I had some things to do this morning, but we got to this, of course, because we do this every week. Market is trading. It's a little bit lower today, this morning, just this morning. But if you look at the past week, we're up almost 1.75%. So almost 1.75% over the past 5 days. The past month, we're up over 3% with some volatility involved in there if you see the chart. But we're up over 3%. We had government shutdown and not knowing how long it was going to be. We'll talk about that later. We had, you know, people talking about a bubble. There was Michael Burry, who said he shorted some of the biggest AI names in the area. Was he indicating that there was a bubble? A lot going on, a lot of different themes, but the market's been chugging along. 6 months, we're at almost 15%, and year to date, we are over 15% from the start of this year. Increase in value over 15% year to date on the S&P 500 index. So that's telling you that the market shrugged off a lot, and that has plays a part in the two economies, right? If you think about who holds stocks, who holds actual assets, it is primarily high income earners, people that have a lot of assets. That is who owns stocks. And so they're benefiting from what we're seeing as a pretty much a surge in the stock market, right? And then you have people that may not have as much stocks that are seeing inflation, because inflation and asset price increases go almost hand in hand. For people that are seeing inflation, higher prices, they're not able to save, not able to put money in stocks. A little different story. So there are that two economies that are really playing a part. You could see it from the chart, you could see it from what's going on in the market, and what you could probably see if you talk to someone at the ground level, how they're actually feeling in this time. So that's interesting enough. Let's get into it. Government shutdown did pretty much end. The longest government shutdown in U.S. history. The president signed a temporary spending bill to reopen the government. This was Wednesday night for those listening the next day. After the measure passed by the House by a slim margin, the legislation uh, was approved by the Senate on Monday and funds the government through January 30th. And the Departments of Agriculture and Veteran Affairs in Congress for all of 2026. Over the historic 43-day stoppage, hundreds of thousands of federal workers were furloughed. Critical economic data was delayed. That's very true. And millions of Americans saw their food security threatened and battled flight disruptions. There was flight disruptions. People couldn't get on different flights. So that was also played a part. So after 43 days, the longest U.S. government shutdown is over, ladies and gentlemen. It's a short-term fix. It's a short-term relief. The real test will be coming in January. They'll have to re-up this in January. There'll be a vote also. There should be a vote on the ACA health credits, tax credits in December, if I'm not mistaken, and then an actual refunding bill vote in January. So we're not out of the woods yet, but it does give some temporary relief. We got a couple months to kind of get our things straight and got to get back to sorts. But that is huge. It's the longest government shutdown, and I think people felt it. Federal workers felt it, and people that were trying to get fly. Luckily we got this done, and I don't know how long it takes for aircraft traffic control to be kind of reinvigorated, but there is a lot to play there because people are going to be traveling for the holidays. And so that's huge, and we'll see how that plays a role in everything. Let's move on to another story that just popped up. Starbucks workers launch a strike on Red Cup Day. So unionized Starbucks workers in 40 cities began a strike on Thursday, a move time to coincide with one of the chain's biggest sales days of the year. The walkout begins on Red Cup Day when the company gives away reusable holiday themed cups, and the union is threatening a lengthy strike involving over 1,000 baristas and 65 cafes. Workers United States represents 12,000 baristas at about 550 of the chain's roughly 10,000 locations. The two sides have been at an impasse since the union rejected a contract proposal in April. So Starbucks Red Cup Day, I guess, is a big deal. Starbucks is doing some interesting stuff. They had this red cup that I didn't know about this, and they came out with new cups that are teddy bear shaped and all this stuff, and people are fighting over them. I saw that on Twitter. I don't know what's going on. Fighting over some teddy bear cups. I don't. Can an adult say that word? I was fighting over some teddy bear cups. Was it actually about the cup? It was. That people really like these cups. I don't know. As an adult, if I could say, I would get in a fight over a teddy bear cup, but that's just me. I'm just different. I'm just a little bit different. But so this isn't a big news because again, Starbucks unionized, and they seem to have different unions because this particular union represents 1,000 baristas and 65 cafes. So they've decided to make this move. But there are also 550 chains, or excuse me, there are about 10,000 U.S. locations. So there's a lot of them, but this specific, union is starting to make a move because they rejected a contract proposal in April, and they're striking now. They're not okay with what's going on, and they want to raise. Of course, Starbucks say, "Hey, we can't give you a raise. It's going to cut into our profit margins," and they're going to say, "Hey, we're just going to use AI. We're going to do this, that." So we'll see what happens. This is a big, big play. Let's talk more about the Fed. The divisions within the Federal Reserve are there's divisions within the Federal Reserve on whether to deliver a third straight interest rate cut in December. Remember, the Fed has been now gone back to cut rates. They did cut in the last meeting amid but they don't have data because of the federal worker shutdown, the government shutdown. They're not getting all the data they need, job data, inflation data. So in December, it's going to be interesting because the drought caused by the government shutdown, they've had a drought in data that they've received. So October's report on employment and price growth are also now unlikely to be released. So the White House said that they're not going to release the report on price growth and employment, that we need that data. They need these data to make decisions. And for the Fed said that makes reconciling views on the risky, sticky inflation and the softening job market trickier. Separately, if Atlanta Fed President Raphael Bostic, who doesn't vote on rates this year, announced he'll retire when his term expires in February. So you got a guy retiring. You got, there's issues with the administration of another Federal Reserve member. There is data that they're not receiving. So how the heck are they going to make this decision um, when we got so much going on? This is yeah. So we'll see. I think it's an interesting thing at play here if they're going to be able to make this decision without all full data. So we'll see. Let's move on. Let's talk more about the stock market, how it correlates to this Fed reopening. The Dow did set a record Wednesday, closing above 48,000 for the first time. This is on the optimism that the government's longest ever shutdown would end, as it did the same evening. The stock index settled up 326 points, or 0.68%, at over 48,000. The S&P closed up a little bit at over 6,850, while the Nasdaq Composite declined a little bit. But you're seeing markets at all-time highs, folks. That's the sentiment here. Is markets are at highs, even with the government shutdown, even with different things. The markets are saying, we don't care, we're pushing forward, and people are investing their assets because, one, you have to put money somewhere. If inflation's eating up dollars, you need to put some money somewhere. That's why they're kind of going hand in hand with that asset inflation as well as price inflation. And so you're seeing that play out here with the market pushing forward, despite what some might say is a trickier economy, or economy with two sides. So that is the very, very much truth. So let's dig more into the market here and see if there's anything at play. We talked about the tech stocks a little bit, the rotation relief. Are people rotating from tech into more value? We'll see if that is more of a theme. Someone said we have rebounded in dramatic fashion from the April lows, and we did. And we called that. We said that we rebound. We did relatively quickly. I don't think there was much freaking out, but if you were, it's a waste of your own time. So we've seen that. So that's what's going on. There's a lot kind of at play here. Let's talk more about Michael Burry. So we did a TikTok on this, but Michael Burry, he's from the Big Short. He's the fame investor from the Big Short. He was one of the first people, if not the first, to call the credit bubble and do a maneuver, an investment maneuver, meaning just shorting the stock market, saying that, hey, this is going to explode in people's faces when the bubble does pop. And he was right. He made billions of dollars on that play, on that risky play. Either it was going to make billions or blow up, and he made billions. So he deregistered his Scion Asset Management, which is his fund. He deregistered it, and he's actually one of the people saying that the AI bubble is a bubble. And he shorted Palantir and Nvidia. He said he shorted Palantir and Nvidia. So let's read it. Bets by Scion Management, which managed 155 million assets of March, have long been dissected for hints of looming bubbles and signs of market froth. In a post on social media platform X, Wednesday, Burry said on to much better things, November 25th. Scion Asset Management did not immediately respond to Reuters' request for comment. Burry has stepped up his criticism of technology heavyweights, including Nvidia and Palantir, in recent weeks, questioning the cloud infrastructure boom and accusing major providers of using aggressive accounting to inflate profits from their massive hardware investments. Someone saying Burry's decision feels like it's calling it quits and more like stepping away from a game he believes is fundamentally rigged. So is he just stepping away because he believes the market's going to go up no matter what he does or says or thinks? So he's argued that a lot of these companies are stretching out their depreciation schedules to make their earnings look smoother. And maybe he's just saying, hey, I can't even stop it. Like people are just going to buy no matter what, registering my SEC registered business, Shine Asset Management. They terminated as of November 10th. Deregistering would imply that the fund is not required to file reports with the regulator, excuse me, or any state. 5 million in assets as of March, according to the latest filing. So that's interesting. Where people are really curious, he just does these like really opaque tweets that people have to like read into, decipher with some sort of manuscript. But we just want to know what it is. Oh, breaking news, folks. We just got breaking news on CNBC while recording. IRS announces 2026 401k contribution limits, raising savings caps. The IRS has announced higher pay contribution limits for 2026. Starting 2026, employees can now defer 24,500 into workplace plans from 23,500 in 2025. Only 14% of participants maxed out 401k plans in 2024. This is according to Vanguard's 2025 How America Saves report. That's okay. You don't always have to max out your 401k. You can use it. You can use other accounts that could be more beneficial for you, more flexible for you, especially if you're younger, and you want to kind of maneuver as your life goes on. You plan to start a business or do any of those likes, you don't have to throw everything into your 401k. So you just got breaking news on the podcast. Well, it's going to be breaking when you get it from me and you listen in and you share this with your family and friends. You know that's how we like Money Life Pod. Break news right as it comes. All right, let's go into the question of the week. I was going to do a couple things, question of the week, roundtable. I liked some questions, so I will dive into those as well as the roundtable. But the first question is, what is the total cost of raising a child from birth to age 17? I think we've gotten this one before. I think we've gotten this before. And was it 200K, 250K, maybe half a million? I don't remember. It's 310,000. So that's 310,000 to raise a kid from the age of 17, or excuse me, from birth to age of 17. You got college, you got paying for their food, you got all those things. And so that's a good one. What percentage of American adults are carrying medical debt? I would say 20%, less than 20%. The answer is 29. Is often so that's 29. So we're close there, really close there. Man, we are cooking with grease. Let's go over the last thing, the roundtable, and talk a little bit about for me, I just want to discuss something I think is important for people. It is really just looking at what happens when you inherit funds, when you inherit funds. So we did a Reddit, there was a Reddit personal finance post on a 19-year-old that just he posted that he inherited 1.5 to 2 million after their dad's passing. And he plans to put some in long-term investments in some of the CDs. So here's what we tell someone in that position. The first thing is slow down. You don't want to make big decisions right away. Let the dopamine reset. Let the grieving happen. Because you can make decisions when emotions are high and can cloud your decision. So you want to slow down, let the money sit for a good second, maybe 6 months before you do anything. Get structure first. You got to work with an advisor, work with an estate attorney to see what's actually coming to you, right? Because like a lot of people, times people think something's coming to them and it's not in the paper. It's not in the actual paperwork. That is a fact. I dealt with inheritance for a good number of people, and you got to make sure you understand what's actually coming, what you're the beneficiary of. Think long term. This is a 19-year-old. You have a lot of time on your side. Think long term. You can be more growth oriented because you are younger, and you can still do it in a diversified way. Also, stay private. There's no need to kind of, you know, tell people too much of what's going on in your situation because that could bring some unwanted attention. In certain cases, especially for a younger person, for a young person to have that. So that's what we have, folks. This is the Your Money Your Life podcast, episode 302. Make sure you share this with your family and friends. If you need them to tap in and get help, please do so. We'll talk to you next.